Welcome to Budgeting 101. Do you find yourself saying yes to spontaneous spending decisions that lock you into long term monthly payments? And I mean, for years. If you fully engage and adopt some strategies of this Budgeting 101 discussion, you will discover your reasons to say no and the principle of making cost savings decisions. Effective financial management involves various tools and strategies that ensure stability and progress towards financial goals. This Budgeting 101 discussion explores the purpose of effective budgeting, a balance sheet, and developing a personal cash flow statement. It includes key component and examples and also practical implementation strategies that you can use immediately. As we continue to deliver more financial educational series, please subscribe to the channel if you receive any value from the information that we're sharing. We're a small yet growing channel related to financial education in the pursuit of financial freedom. Before we go any further, let's get on the same page about budgeting. The purpose of effective budgeting is the process of creating a plan for managing money. It involves tracking income, expenses, and savings to achieve financial goals. Let's go through some purposes. One purpose is to expense management, tracking your expenses. Control and monitor spending to ensure it aligns with your financial goals. For example, take a look at your monthly banking statement. If you really take a look at your itemized spending, it starts to reflect your internal values as it relates to you as a person. Keep that in mind, and those are some things that you can really flag if what you're spending on a monthly basis is not aligning with what you know your internal values are. It really comes to light on those financial statements. One example is limiting your dining out expenses to $200 a month. The number here is not important, but be mindful and you're capping how much money you spend towards dining. That's that want category as it relates to your salary. How much money should you be spending on the things that you want, but you don't necessarily need it? Another purpose is income allocation. Assigning income to various categories such as savings, bills, and discretionary spending. We spoke about this in our previous Savings 101 video and goal setting video in terms of allocating 20% of your salary to savings, 30% to your wants, and 50% to your needs. And that's standard across the board and give you a good benchmark to work from. Another purpose for budgeting is debt reduction, creating a strategy to pay off debt systematically. Here's an example. Allocating an extra $100 per month to pay off your credit card debt. Okay, the number here, once again, is not important as it is to the action. So whether you have a credit card that has a high interest rate or you have a credit card that carrying a low balance, whichever make you feel good in paying off first, that's the one you should attack and apply your additional funds to. Lastly, another purpose is for financial goal achievement, allocating funds for a specific goal, such as buying a home or funding education. Example, saving $500 per month for a future down payment on a house. And I spoke about how your spending reflects your internal values. So consider the suggestion I shared here related to the purpose of budgeting. You really start to see one's values start to come across in terms of how strategically they actually spend their income and what means the most to them and their family. Understanding the balance sheet. A balance sheet is a financial statement that provides a snapshot of an individual financial position at a specific point in time. The balance sheet highlights assets and liability assessments. It actually summarizes what you own versus what you owe. Let's provide an example. Let's just say you own a home outright, free and clear, for $300,000. And also you have liabilities. You owe the bank, or you owe on a car loan and credit card to the amount of $150,000. And that's your liabilities. Let's get to the net worth calculation. The net worth calculation actually is very straightforward. It's actually taking how much you actually own minus how much you actually owe. So it's the $300,000 minus the $150,000, which equals $150,000 would be your net worth calculation. The net worth calculation is really a financial health statement. It provides a holistic view of your net worth, which indicate your financial stability. And let's list some components. When you roll up your sleeve and you start this process to go through the process of looking at and calculating your net worth and doing this calculation, the most difficult part is actually getting a piece of paper and a pencil and jotting down your assets. It'll take some time, but you'll get used to it after doing it several times. Let's say, so first you would want to do is list all your assets. List all the things that you actually own. And then you list all the things that you owe. Look at your banking statement. Where's your money going out to pay a bank or institution? I'm not talking about your cash flow in terms of light bill, water bill. We're talking about money where you have taken out a loan to pay a bank on a long-term basis, long-term liabilities. Okay, so once you do that and list all your assets and your liability, compile a detailed list including current values and outstanding balances. And then calculate your net worth. You take the how much you own minus how much you actually owe your liability, and then you come to your determination of what your overall net worth is. And you want to repeat and recycle this process probably once a year. I normally do it after tax time. Since I'm doing taxes already with my tax advisor, this is something I conduct right around that time to actually determine what my net worth is, if it increase or decrease, so I can know what my financial position is at that point in time. Developing a personal cash flow statement. A cash flow statement actually tracks the movement of money in and out of an individual account over a specific period of time. Now, I personally like to do one for 1 month, wherein I can look at the ins and out based on a 1 month period, and then associate it to 6 months and project it out to a year if I can. But as long as I have it down to the 1 month period of time, that can either help me once again kind of focus on that 1 month or look at it over a year. The purpose of a cash flow statement is actually an income and expense analysis. It provides insight into sources of income and areas of expenditures. Example is like whether you have a surplus at the end of the month or a deficit in cash flow at the end of the month. Ever thinking that you're just never making enough, and once you pay all your bill, you're left with nothing? A cash flow statement would actually highlight that and call it out before you start to feel it repetitively every month, where you can quickly look at your outgoing expenses, make some adjustments, therefore you will have some additional money at the end of your month. So this is how a cash flow statement is really my favorite budgeting tool. It also ensures that you align your income and your expenses with your budget. We talked about the 20% for saving, 30% for your wants, and 50% for your needs. Once you look at your cash flow statement and you align that up with how you're spending your salary, there need to be some type of alignment and line of sight from your cash flow statement to the values that you have with spending money, and making sure that you're not going over that 30% of your salary with things that you want, i.e., discretionary spending. Another useful tool for the cash flow statement is actually identifying trends, recognizes pattern in spending and earnings. An example is noticing a consistent increase in discretionary spending, like I just mentioned, that 30%. Knowing that you just enrolled or bought some additional subscriptions to watch on TV that is now taking you over that 30% towards things that you want but you don't necessarily need. And we know how subscriptions with movies and series, HBO, Netflix, and Amazon can really get out of hand if you're not really monitoring how much money is going out on a monthly basis when you really just need one, or you can really live without it. Here are some components of the cash flow statement. These are some line items, things that you'll see on every cash flow statement where you have kind of list out your income. This could be wages, bonuses, investment income, such as, let's just say, $5,000 monthly salary. You would list it, or $200 monthly dividend income. These are things that you would list on your cash flow statement as sources of income for that particular month. Now, there will be another category, and we'll go through this on future discussions where we do more of a hands-on and work from a template. But this is just an overview of what a cash flow statement has in terms of information and what it collects. It also collects your expenses, which is your rent, your mortgage, utility, groceries. Let's just say $1,500 for rent, $200 for utility, and you'll list $400 for groceries, and so on and so forth. Even like health expenses, you'll list that as expenses on a monthly basis on your cash flow statement. And then once your income is all calculated and then your expenses outgoing is calculated as well, what you will be left with is whether you're in a deficit for that month or whether you're in a surplus. So this can kind of categorize your transactions and then give you a true assessment in terms of, are you in a profit at the end of the month, or you're right at zero, where you truly can answer the question in terms of, it feels like I'm making just enough money to pay bills. You can't answer that question until you have a cash flow statement. Effective budgeting, balance sheets, and cash flow statements are indispensable tools for managing personal finance. They provide a comprehensive view of income, expenses, asset, and liabilities, enabling informed decision making. If you recall, at the beginning of our Budgeting 101 discussion, we talked about making spontaneous spending decisions. And after listening to this discussion, you'll be able to make more informed one, which will answer the question before you make that purchase, whether or not you can afford it. Because your cash flow statement and your balance sheet will inform you prior to you making those decisions. By implementing these strategies and regularly reviewing your financial statements, i.e., cash flow statement and the balance statement sheet that we covered in this discussion, you can gain more control over your financial well-being, work towards achieving goals, and build a more financial future. If you receive any value from the Budgeting 101 discussion, please like and subscribe. Until next time.